The trading book I wish I'd read sooner. If someone had handed me this book in my first year of trading, it would have saved me thousands of dollars, countless hours studying useless ideas, and the emotional roller coaster of thinking I was just one indicator away from consistent profits. Now, this book contains the systematic approach that could have prevented all of that trial and error. So today, I'm going to be breaking down 4 tactical lessons that would have changed everything if I had learned them from day one. Now, before we dive into these 4 tactical lessons, who is Robert Carver? And does he know what he's actually talking about? He is the author of this book over here, Systematic Trading. Systematic Trading, a unique method for designing, trading, and investing system. Now, he actually managed a multi-billion-dollar fixed income portfolio at AHL, which is one of the largest systematic hedge funds in the world. Now, prior to that, he also worked as a research manager for CAPR. It's basically an economics think tank, and he also traded exotic derivatives for Barclays Investment Bank. So summing that all up, he's definitely got experience in the space of systematic trading, and he now also manages his own money in a fully systematic method, primarily trading risk premiums. Now, if you're not too sure what that word means, don't worry, I have other videos on the channel that cover in detail what risk premiums and inefficiencies are. I'll also maybe touch upon it in this video as well. Now, the first tactical lesson is the importance of data. Carver specifically specifies that he prefers strategies tested over many decades of history, as this provides a more robust performance across different market regimes. Plus, the more data, the better, at least most of the time. This means no 10 sample backtests. We want statistical significance, and that only comes from hundreds of samples. Now, to show you how that actually looks in a graph, this is the number of throws of a particular dice over X amount of samples. So as we can see here, within like the 1 to basically, let's say 50 samples, we're getting huge variance, right? We can see the expected values around 4, then at 3, then at 3.5, obviously, but we're getting a lot of variance here. And as we get more samples, it's more going to the exact expected value or what we would expect to happen when you throw a dice. Or think of this as well with a coin flip, right? In the first couple of coin flips, you could maybe get heads 5 times in a row, but is that a strong likelihood to happen over 1,000, 10,000 samples? No, you're not going to be getting heads that many times in a row. And this exact principle needs to be applied to trading. It's primarily the law of large numbers. We want a trading system or strategy that has positive expected value over a long enough period of samples. If something has positive expected value over 10 samples, that just really isn't enough for us to know, is this something that's going to be working for a long period of time? Now, number 2 is the 3 main ways traders blow up. Now, this can be summed up to bleeding to death slowly by paying too much in costs, or exploding quickly by using too much leverage. And these both stem from overconfidence, and then the last one is overtrading. Now, this one stems from impatience and poor criteria selection or conviction. Let me break down each one of these a bit more. So for paying too much in costs, this is a very key thing to consider when you're backtesting. If you're backtesting a strategy, and let's say it's taking a lot of trades, so let's maybe say it's 100 a week, if you're not factoring in slippage and costs, so costs would be commissions, locates, funding rates if you're doing crypto, for example, if you're not factoring those in, then it will most likely look like an amazing strategy without those. But once you actually trade it live and you have all of those real costs being applied to your trades, it will quickly become unprofitable. And this is because to have a trading system that has thousands of samples and is often on a lower time frame is a lot harder to find something that has positive expected value when you take into account all those costs. So you do need a balance between the amount of trades you're taking, which is also why I mentioned it here at the bottom, overtrading, plus the amount of costs. And then 2 is by using too much leverage. This is very simple to understand. A lot of times traders just simply want to over risk because they want to grow faster, or they're overconfident because they think, oh, I've had a really nice, let's say, winning streak, and I've won all trades last week, and now you're going to put on way more size because you're really convinced that the next trade's also going to be a win. And then the last one is overtrading. If you don't understand what is making you money or what your criteria is for your particular trading strategy, or maybe you don't have enough conviction because you haven't tested it well enough, that's going to lead you to trading suboptimal opportunities or trying to find more opportunities for you to trade. Now, number 3 is simplicity in trading systems. Robert Carver emphasizes keeping trading rules and strategies as simple as possible. Avoid overcomplication for marginal improvements in backtest. Simple systems tend to be more robust. And this is very true from my own experience. I've been trading for the past 6 years, and now I'm primarily fully automated in the futures and crypto markets. And a lot of my strategies are dead simple. The common string of thinking here is that, well, if they're so simple, why do they work? Because most of the time you're getting paid for taking risk on, or the inefficiency is very simple in in itself, meaning that it's quite simple to understand, but there's complexities about executing it or for the amount of time it actually exists, or even finding it, for example. So to give you a very basic example, one of my most simple systems is just a trend following breakout system that is primarily longing when certain X amount of days highs are broken above. It's less than, let's say, 3 parameters, basically. When things are moving higher and trending up higher, it does incredibly well. It's very simple. You don't have to be too worried that I've overfitted it or I've, done a million optimizations just to try to find the best results historically, but then it actually doesn't work live and practically. Now, the last one is to understand where your profits actually come from. Robert Carver makes a crucial point about what separates consistently profitable traders from those who lose. He says profitable trading comes from careful research done by people who actually understand where the profits come from. The losing traders he's seen are usually doing random data mining without any real understanding of why a strategy worked in the past or whether it will work in the future. He also calls out the unrealistic expectations most traders have. They'll see a backtest with a Sharpe ratio of 3 or 4 and think that's achievable, but those numbers are usually just overfitting. In reality, you're going to be getting a Sharpe ratio above 1, and that's actually normally pretty good. The magic really more happens when you're combining a balanced portfolio of different trading rules/strategy types rather than trying to find one perfect strategy. To kind of double click on understanding where profits come from, that's what I was primarily talking to before with inefficiencies and risk premiums. A lot of times people think they're trading and they think they're exploiting an inefficiency, right? Like the market hasn't priced this in, or the market hasn't seen this before, or there's no big institutions doing it. Now, most of the case, they probably have, but it's maybe not worth it for them, or you're getting paid for taking on a risk that you don't even really understand. Or if you do understand it, then you're just basically trading it the correct way. So a very easy one, right, is trend following in equities markets. Why have those consistently performed quite well? And fundamentally, it's because you're taking on drawdown risk and also variance in returns. Trend following, for the most part, has a very good couple of months, and then it will be in drawdown for a decent period of time, maybe even a year, maybe 6 months, etc. And then you'll make back all your returns, in 2 to 3 months. But that isn't a very nice return profile for someone that wants to be consistently earning money, let's say month to month in a fund. That's why a lot of funds do things like market making and more, let's say, complex and competitive advantages because they can get more, let's say, guaranteed in quotes, returns per month. Whereas for most retail, we want to be exploiting areas where we have less competition, meaning there's probably going to be less liquidity, or there's going to be capacities on how much we can push through that particular strategy or, let's say, edge. Or it's just simply not good enough for their return profiles for them to really exploit the whole thing. The easiest case of that is trend following. And then you can also double layer that by going into a more inefficient market. For example, doing trend following in crypto markets is one of the better markets to do it because you'll get the highest return profile from it, but you will also be experiencing the most variance, meaning you will have a decent amount of drawdown time and also percentage. Conversely, let's say you're not doing a risk premium. Let's say you're doing a pure inefficiency. A pure inefficiency is you're going to be buying something cheaper on one exchange and selling it on another exchange. But there's a lot of complexities between that, and most of the time, those sort of arbitrage examples are going to be priced out by bigger funds or just people that have bigger teams than you for the most part. Now, there are going to be places where you can do that, but it's going to be very low liquidity. For example, a great place right now is you can kind of do manual market making on Polymarket, but it's not going to be anything close to, what you would maybe hope for with a bigger account, like making thousands of dollars per day. It's more going to be maybe in the hundreds of dollars per day, which is still great. And obviously, we don't know how long that inefficiency is going to last there, where you can actually basically do manual market making in Polymarket. But that's primarily because there isn't a lot of competition there yet. There's huge spreads. And also, it's quite a hard thing to model out what is the fair value for it. And then 2, you're taking on tail risk. Because if something instantly changes to yes and you are carrying too much of an allocation on that particular vote on Polymarket, then you're going to suffer quite a serious loss. Now, these are just general examples, so please excuse my kind of overview of them, but hopefully that gives you an example of this important lesson of understanding where your profits come from. I'll leave the book name in the description, but if you just want to take a quick look at the cover, it's by Robert Carver, and it's a very simple name, Systematic Trading. My apologies for the poor microphone on this one. I'm currently away from my main computer, so I'm just recording this on a laptop, but I wanted to get this video out for everyone.